Good day, everyone. It's the top of the hour, so we're going to go ahead and start and honor those who are here, honor your time. We've got so much to talk about today. The headlines are flowing by the hour, and that's impacting the markets. We're going to try to cover as much as possible. I'm going to tell you right up front, I've got a lot of slides. I cut a lot of slides. And basically, I'm going to encourage you on some of these slides. I'm not going to spend a lot of time, but I know many of you like to go back and view the on-demand, and you can then study the slides a little bit more in depth when you do so. So some of them I'll go through quicker than what you'd like, knowing that there are some of you who'd like to see that and go back and then study the on-demand version. So hopefully that'll work. Always feel free to give me your feedback on it. But let's go ahead and get started now. First of all, I should put up the disclaimer slide. I need to do that. And hopefully you're very familiar with this slide by now and are comfortable with it. Price is still a function of supply and demand as modified by the flow of money. And that continues to be so true. Now, I want to show you this, the unemployment slide, and we just did tick higher, 4.1% in a report that came out on Friday. But I want to show you a long-term picture. This looks back at the last 54, 55 years to give you an idea what 4.1% looks like. All we think about is how high it is now relative to the last couple of years. It did peak back in August or so at 4.3%. Went down to 4%, now at 4.1%. And I anticipate that it's going to go higher with the number of federal employees losing their jobs. And we're going to look at that a little bit closer. You can obviously see the spike from the pandemic on the right, but if you go beyond that, because that's obviously an outlier, we're at very low levels from a historical standpoint. And I just want to provide a little bit of perspective for you on that. Consumer Price Index data will be updated tomorrow. So I wish we could have had it for today, but that'll be updated tomorrow. And so wanted to let you see where we're at right now for both the headline CPI, which has been trending higher in recent months, and the core, which has been going pretty flat, both well above the 2% mandated level, and where we are versus this pattern of where we were in the 70s and 80s. National debt, $36.6 trillion. The Congress still needs to deal with this issue of raising the debt ceiling. And they say that we can go into maybe late spring or early summer with the Treasury Department simply using creative bookkeeping to pay the bills. So I wanted to keep you updated on that. I'm not going to go into that too much more. With interest rates coming down, though, we've actually lowered the annual cost of interest payments on that debt to $1.01 trillion. That was at 1.05 trillion just about a week or two ago. So that's a positive development there. Total U.S. tax revenue this year estimated at 5.05 trillion. If you look at those four categories that are circled there, that's exactly what that basically comes to, is $5.05 trillion. And we haven't even got to the bulk of the discretionary part of the budget, which is what Congress is working on now. I thought some of you would also find it interesting. This is a breakdown on the Treasury Department's website of where the money goes, which department it goes to. On the left, the actual dollars, and on the right, it's basically the same chart, but indicating the percent of the budget that it represents. And so I thought you might like to see that as well. When we look at from a little bit more historical perspective, I'm going to focus there on the right, the annual deficit, how we got to that $36 trillion and where we're going from here in projected annual deficits. And you can see that we're trending higher. Now, obviously, the pandemic, we really spiked. But that aside, pandemic aside, we're really trending in the wrong direction. And if you look at where our total deficit is there at the bottom versus the annual deficit that we're adding on, you can see the past 5 years, including this year and the previous 4 years, how much we're adding on each year. with that deficit. And that is what DOGE is trying to address. But that, from my standpoint, what I've been saying for the last 2 years really is we've got to get this under control, because it's starting to have an impact on our economy and on our credit markets overall, and also on the, what do I want to say, on interest rates. And that's what we have to get in control. And we're starting to see that steepening of the yield curve once again in recent days. Now, if we look at the federal employee count, because there's been so many news headlines about federal employees being laid off and everything, so I got curious. I wanted to provide some perspective. So went back to the data from the U.S. Bureau of Labor Statistics that I was able to access from the Federal Reserve out of the St. Louis area. They've got a great website for doing that. And I found this data and I put it on a chart. Now, the spikes that you see there is when they hire a lot of people to do the census every 10 years. So try to look beyond the spikes. And you see that during the 1980s, we grew the federal government. And then during the 1990s, we saw President Clinton working closely with Newt Gingrich, and they shrank the size of government. And then we grew it somewhat right around 2008 during the Bush Jr. years. And then really from 2014 is when we kind of bottomed out, late 2013, 2014, and we started growing it again. And then after, well, really, as we look at 2022, we started rapidly growing government, accelerating at a rapid pace until now the number of civil service employees we have is at a 30-year high, essentially, not counting those census years. So I wanted to provide a little bit of perspective, because I hear a lot of things, and I wanted to, okay, where are we in the number of civil servants and stuff like that? So I'll throw that in there for you. Overall, I would continue to say U.S. fiscal policy is on an unsustainable path. We do have a continuing resolution, which the House is working on trying to pass today to fund the government. The current CR funds us until March 14th, which is this week. Today's 11th, so that'd be till Friday. Without another CR approved before then and signed by the president, we have a partial shutdown of the government. And so the House is working on another bill to try to do that. And then it'll have to go to the Senate, where it'll take 60 votes, which means the Republicans will have to get some Democratic votes to do that. And so far, the Democrats are saying we're not going to vote for anything coming out of the House right now. So this will be interesting, something else to keep your eyes on. We still got to address the debt ceiling. But as I said, we've got some time on that. The sovereign debt credit downgrade could happen at any time without warning if the credit rating agencies feel like there's political gridlock. Reports that Canada, this came out today, unconfirmed reports that Canada may start liquidating some of its bond holdings as part of its, assumed this is a retaliatory step for the tariff battle right now. And so right now what we're seeing is we've overall, the general trend, I say right now, I'm talking broader days rather than currently today, we have been seeing some increase in demand for treasuries that have been kind of meeting this demand to absorb the supply of debt certificates because of a rush to safety. As the stock market's been trending sharply lower, we've had some rush to safety, which means government securities. That's been providing some of the demand. But Canada, we know that Japan has been pulling out because they have positive interest rates again, so some of that money's coming home. China has been as well overall. And now Canada indicating that they could do so as well. So that means we need to continue to find a source of buyers for these debt certificates, or it pushes those longer term interest rates higher.